Hey, and welcome back to Growth Mode, where we are all a work in progress. In today's video, I'm going to walk you through how the wealthy pay $0 in taxes. Now, this is a fun topic because it can be pretty controversial, but what I'm hoping to do in this video is actually walk you through an example of logistically how this plays out. Because I think oftentimes we see a headline, right? And it's X billionaire pays $0 in taxes, or they pay less taxes than one of their entry-level employees. And that stirs up a lot of commentary and people getting mad and all this stuff. And it's like, well, let's dive into this a little bit and just look at why. Because a lot of times these people, they're not doing anything shady. They're actually just following the tax code that has been laid out for us that we're all following. So we all have to follow the same tax code. So let's dive into an example of how this plays out and then how you can use some of these strategies to benefit your own situation. Because at the end of the day, it doesn't matter what that billionaire is doing or what they're not doing. I want you to be able to use the same information that they have to work it to your advantage. All right, let's get into it. All right, so let's dive in and I'll set the stage here. We're basically going to compare a example of the non-asset owner and an asset owner. And so in the example I used in the intro, basically you've got a billionaire and maybe their entry-level employee. You could kind of compare the two, but really this scenario plays out in a lot of different instances. So on this side, we want to look at somebody. This could be a very typical scenario where somebody's got a job and they're earning that income for the work that they're doing. So maybe that job is paying them $40,000 a year. And so this is how it plays out for taxes. They're going to pay $4,600 and their effective tax rate is 11.5. Now, I want to spend a quick minute here explaining how the tax rates work, because I think there's a lot of confusion around that. And then we'll work into how this person can actually end up paying $0 in taxes. Okay, so this person is making $40,000. So the way our tax system works is anything 0 to 98.75 in terms of income in a year, you'll pay 10% on that. Then as you earn more than 98.75, you will start paying 12% on anything over 98.75, so 98.76 and up to 40,125. Now, this is for 2021 numbers, so these will change over time, but this is how these numbers play out currently. Then, as you earn more than 40,000, you will actually pay 22% on that. So if you're making 60 grand, you're going to pay 22% on the difference between 60,000 and 40,126. So when you bump into a higher tax bracket, there's a lot of confusion. People go, well, I don't want to make any more money because that'll bump me into the higher tax bracket. That is garbage. Generally, you always want to earn more money because you're paying 10% on this, and then you'll only pay 12% on anything over that, and then you'll pay 22% on anything over that, and then over 85, it jumps you to the next tax bracket. So just because you're making $86,000 doesn't mean all of a sudden you're going to jump into this next bracket and pay 25 or 28% on everything. It's just everything over this number. So you'll always come out ahead by earning more. The only question that comes up is, do I really want to work more and harder to make that money? And maybe at some point it's not worth it because you're saying, hey, for everything over 85,000, I'm paying X percentage, but that's another story. So that's how this plays out. So this person making 40,000, their effective tax rate is in between these because they're not paying 12% on everything. They're paying 12% on everything between 98.76 and 40,125. Okay, so they're paying 4,600 in taxes. Let's go over to this person. So this person has a bunch of assets. They have 10 single family houses, and I'll get to that here in a second. But they also have a business. So they have, let's just say they have a business that's doing $2 million in annual revenue. Now that's top line. Then they have expenses, right? They have employee salaries, they have software, they have rent for their office space, they have marketing and advertising costs, they have sales costs, they have bookkeeping costs, like lots of expenses, right? And let's just say this year, those also totaled 2 million. So they broke even. They made no money this year. They had 2 million in revenue, and then they had to spend it all on expenses. So what are they going to pay in taxes? 0. And so that puts them in the 0% tax bracket. So you're thinking, okay, but this person probably needs money to live. Yes, they do. So where are they going to get that money? Well, they have these 10 single family houses. So let's look at how that plays out. So down here are their houses, and they have values associated with them. And then they also have mortgages on all of those properties. But the differential is going to be their equity in the property. So if you have a house that's worth 350 and you owe 150 in terms of what is remaining on the mortgage, then you've got $200,000 in equity, and it's sitting in the property. So it's not like this is sitting in cash, it's tied up in the property. So you have 1.2 million in equity. Well, if this person is saying, hey, I'm really trying to grow my business right now, and maybe towards the end of the year, it's December, and they're like, oh, I'm going to show a profit of, 50 grand or something like that. They might say, you know what, I'm going to spend 50 grand in marketing right at the end of the year, and maybe I'm going to sign a contract, or I'm going to do a bunch of ads and run those, and I'm going to try to get my income down to 0 because they're investing for the future. So they're pouring all of that 50 grand back into the business in hopes for future growth. Well, that brings, again, their income down to 0 instead of having $50,000 in profit, which would get taxed. But again, that comes back to, where is this person going to get the money to live? Well, if they have all these properties and they've got this 1.2 million in equity, they can actually do a cash out refinance. And if you haven't watched my video on cash out refis, you should go check that out, because that walks through the details of how this works. But basically, this person could say, you know what, I'm going to refinance house number 1, and it's got $200,000 in equity. I want to pull, let's say, $100,000 out, because that's what I need to live on, or maybe it's 70,000 or whatever the number is. So let's just say they're going to take out 75,000. So we'll use that number. We'll make it a little bigger here. So they're going to strip out $75,000 in equity. That means this debt is going to get refinanced. And so we're going to add $75,000 to this mortgage, and that's going to put it at 225. And so now they have $125,000 in equity. So less equity. And we're just, for the sake of simplicity, assuming these are all just breaking even for cash flow. So I didn't get into that because that would complicate the situation. And so now they've refinanced it. They've pulled this cash out. And when you pull that out, that's actually debt. And so they're not actually, this isn't income to this person. So this money is not taxed. This is completely legal. It follows all the tax codes. And now they could say, live on this 75,000 for the whole year. And since it's tax-free, you could look at this as after-tax income. This probably somebody needs to, if they're working a job, they would probably need to maybe say make 100,000 or 90,000. I haven't done the math here, to actually have $75,000 in after-tax dollars. So this is really powerful. So now they've got the 75,000, they can live on that. They can continue to push the limits on their business by reinvesting, and basically getting this down to breaking even. So they're not paying taxes on earned income. And now they have $75,000 to live. So if somebody has a bunch of assets, and those assets are growing in value, and especially if it's real estate, they can continue to refinance these properties year over year. And they might say, oh, this one's got a whole bunch of equity, like this one has 200. So maybe next year I'll pull out some equity from that one. And then these values will go up, the debt gets paid down by the renters, and they can kind of cycle through these different properties, stripping some equity every year. And then the values will all continue to grow. And so, they could basically pull equity out of one property every year for a decade. And then by the time they get back to this one and say, maybe they need to pull some equity, this value's probably gone up to, 450, and they might have another 100 grand in equity. Again, I'm just kind of forecasting out here. And this is just to serve as an example of how this happens. But you can see this person just got $75,000 in their pocket, tax-free, even though they have a business that's growing and they're working it, but they got their profitability down to 0. So I hope that this video kind of just gave you one example of how this is possible for people that have a lot of wealth, right? This person's got over $1 million in equity in their properties. So if they don't have a whole bunch of other debts, they're in the millionaire status, and they're paying $0 in taxes in this example. So what I want you to do is think about how can you start building up your assets and building some equity for yourself. And then you can start to use some of these strategies and say, oh, maybe I can actually get my income from my assets and growth from those. And those are either a lot of times they're taxed at a lot lower rate, so they have capital gains, which are taxed lower typically than earned income, or in this case of using real estate, then you can actually pull out that equity tax free. So take this, use it to your advantage, and hopefully this kind of explained how this is even possible. And if you thought this was good or you learned something, please share it with a friend. We're trying to spread the word in terms of financial information so that we can all keep improving our own situations and creating financial freedom for ourselves. See you next time here on Growth Mode.